In this video, I will explain market structure in a way that a 6-year-old child will understand. If you have been struggling with market structure, this is the video for you. Because in this video, I will show you what constitutes a trend, how to identify a reversal in the market. This is where a lot of people get it wrong. And the teaching out there also contributes to the huge failure rate. I'm going to show you what constitutes a valid break in market structure. I'm going to show you what is not considered a break in market structure. I'm going to show you a chalk and how you should be trading using market structure so as to profit in the market. So if this sounds good to you and you don't want to be failing with market structure, stay to the end and I will share real life examples to you. So let's dive in. So in a proper market, this is how the market moves. Okay, we need to understand this movement in an hypothetical nature before we move into the chart. So you have to pay attention. Even if you think you know what market structure is, you are going to learn one thing or the other from this video. So you can see your market move up to this level. There are things you need to understand when it comes to market structure. The first move upward here for a bullish trend is called impulse. We have an impulse leg, which is a movement in line with the trend. Impulse, or you call it an expansion. So I know some of you will say, is it not an expansion? It's the same thing. Impulse or expansion. Now the second leg is called a correction. You can also call it a pullback. You can also call it a retracement. So I'm not here to talk about those terms. So you need to understand I might use them interchangeably. So we have an impulse leg up, creating a high, and the correction creating a higher low. Higher low in the sense that is higher than this previous low. Simple as that. So don't let all of this confuse you. So from this low, it pushed higher to create a higher high. Higher high in the sense that is higher than this high. Then a pullback, higher lows, you get the gist, higher lows and so on. Price move up. In this case, how do you trade this? When market break, this is BOS. BOS simply stands for break of structure. And what constitutes a BOS is when there's a body close above this structure swing point here. Not a wick taking it. If a wick grabs it and return back in, that is not a break. Take note of that. For example, if you look at this wick did not break this high. Instead, this body here, this candle with the body close is the break. Okay, this is what I mean by break in market structure. Some people might have it in their rules that a wick is considered a break. There is no problem. But for me, and if you want to listen to me, only a body close above this will be considered a break in market structure. So let's continue. So from there, we move up. When you see that break in market structure, you position yourself to buy in any of these points of interest. There will be a lot of points of interest in here. Some here, some here, some here, some here, based on your order block, fair value gaps, hidden basis, and so on. In this video, I'm not going to show you which of these points of interest is high probability. Instead, I want to show you how to read structure. Okay? So a pullback into any of these points of interest here will continue the trend. Give us a break, a body close above. A pullback into the point of interest will continue the trend. Okay? Gives us a break, a pullback into the point of interest will continue the trend. Now, if you look at this, you see higher high, higher low, higher low, higher low. It's confusing, right? Yes. Now, this is what it means. It means that before this leg came back down here, I want to explain. This is where a lot of people miss it. You have to label your chart. Okay? There's nothing like a valid pullback. Some people will say, oh, what a comment once asked me, what do you consider a valid pullback? I was like, where did you learn that from? valid pullback. There's nothing like valid pullback. A pullback is a pullback. Okay, what you need to do is to give yourself rules to know if you have to take a trade based on those pullback. Now, when this market pull back down to this point here, maybe you can even extend it lower, because some people think is based on, okay, pull back, you take your trade. Giving us a break, you need to look for trade in here. But what happened? We have a break of this low. Now, when this low gets broken, this is where a lot of newbie traders or less informed traders will start looking for shorts. They start looking for ways to sell the market at this particular order block. Okay, they set a limit order here, stop loss above, for the market to reverse. They call this a shift in market structure. Wrong. This is not a shift in market structure. Now, you can see that the market has been trending bullish up on this one. Do you think one break of a low is considered a shift in market structure? No. What we consider a shift in market structure is if this low gets broken. If this low gets broken, which is the low that produced the high that was broken. If this low, you trace that high that was broken, if that low gets taken, then you have a shift in market structure. So this here, a break below this simply means a shift in market structure. Okay, simply means a shift, and this is where you start looking for more trades to the downside. But here's what happens. When this level gets broken, I will be looking for trades in here. Then this low now serves as what? An inducement. Now take note. Most people will tell you this is an inducement before this happens. No. Every high and lows on the chart is an inducement. This is an inducement, this is an inducement, this is an, because they are all liquidity. Okay? They are all liquidity. We don't know which liquidity we hold, especially if this low takes liquidity before we break it. Okay? But what you can do is, there's nothing wrong for you to look for trades in here because the market is bullish. A break of structure, this supply zone or this demand zone that broke this structure can serve as what? A point of interest to push higher. Now the market does what it does. It took out that zone, probably inducing you here to take a trade. But this is a very good A+ setup. It doesn't come all the time because this low serves as what? Inducement. The only leg that needs to go is that low that produced the high that was broken. Take note. The lows that produced this high that was taken confirms the strong structure leg, and if that leg gets broken, then we have a shift in market structure. So this is how most people trade. They look for chalk and then immediately they start looking for sell. What happens? Market comes up and takes them out. Okay, all you need to do, don't take my word for it, go back, test it, check on the chart. I will show you on the chart so that you will not fall victim. Now let's look at on the bearish side. We have a low, a retracement creating a lower high because it's lower than this high. This move breaking this low with a body close. The pullback, this created a lower low because it's lower than this low. Okay, you understand it now. Lower low, lower than this, lower low, lower than this, and so on. And this also creates a lower high that is lower than this. Market breaks. Now in all of this, you take your trade because market come back into premium for a bearish move. You take your trade, especially if it's above the 50% mark. You take your trade, you take your trade. But once price gets here, what happens? We have a break here. This is called a chalk, change of character. Most people will want to be looking for sell in here. They want to sell. But what they don't understand is this is not a shift in market structure. Market comes down and takes them out, and then the trend continues. And they wonder what is the problem with this. The problem is you are treating a chalk as a sign of a market reversal, which simply means an early indication. Okay, because this happened gives you an early indication that, oh, market might be reversing in here. Okay, but always stick to continue the bearish move up until this low is taken. If this low gets taken, then I'll be looking to start trusting this point of interest for a push higher, or any of the point of interest here, or whatever supply or demand zone that breaks this low. I can look for trades in there to continue pushing higher. Okay, so these are simple things you need to understand. Do not try to pick the bottom of the market. Okay, and do not try to take every chalk as a sign of market reversal. No, the market will continue to trend until it trends no more, and if the trend ends once it takes out this low, this high that was taken, it trades back the low that produced it. Once that low is gone, because that range, this is the range, this trading range has been violated. Once you violate this trading range, then you can look for what? Move into a new trading range. That means from this low to this high. This will be your new trading range where you can start looking for what? Trade. These looks confusing, but when you practice it, you understand better. Now, there's another thing I want to share here when it comes to the way the market structure moves, and I will get to it next. We are going to look at this in a bullish move. Now, this is a more complex bullish price action. Okay, you have a low, you have a high. That high produces a low which is lower than this. Now, most people, when they have that break here, where is the low that took out this high? Some people will mark here as the low. No, trace the origin. Always learn to go back to the origin. This is the low that takes out that high. So anything in here is simply internal structure. Okay, internal structure, and those internal structure are very low traps. Okay, for liquidity sweep. Or market can go sweep this low and then continue going higher. Okay, so these are another thing I want you to see. Market came back down. Before coming back down, it gave a kind of pullback, move up. This from year to year is your range. 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 Now, this is the last high that was broken. One market closed below this. That is not a shift in market structure yet. Okay, it can give you an opportunity to trade short, but you want to be buying in here. You want to be buying in here to continue attacking that high until this low gets taken. That means that range, that structure range that we were looking at for a buy, once it gets taken, then you start looking for a short. Okay, you start looking for short to the downside. Same thing happens on the bearish side. So we are going to look at a chart on Euro USD and see how we can tackle this and break this down even further. So yeah, you can see we have a push up here, high, low, high, low, high, low, high, low. Now from year to year, this is the last high that was taken. Okay, let's see if we add a swing structure here. Okay, we have a swing structure here. So you have to count that. Okay, we have a low, a high, a higher low, breaking this, higher high, pull back, lower low, higher low, sorry, higher high, higher low, higher high, higher low, higher high. Now, when this gets broken, okay, this is an early indication that we might reverse. So you can start looking for trade here. Now don't worry about this. Oh, you've gotten a loss. Raba has taught me nonsense. No, it's not nonsense. Now, this gives you more confidence to start looking for the bearish trade once market closes below this. Okay, once we have a close below this, you can now shift immediately to start looking for shorts. We have a new trend forming now. This is a high, this is a low, this is a higher, a lower high, a lower low, because we are bearish now. Then, where do you want price to break before you can say the market has continued shifting higher? You want market to take out this. This is the last low that was taken, and we trace it back this. So now this created a new low. Market trade up. You can see there's no break of market structure here. Market didn't break structure, it swept liquidity. So in that case, this becomes the lower high. This is now the lower low. So this is our new lower high here. Okay. This is our new lower high here. Let me use the magnet to. We broke this low. This is a lower low. This is a lower high. Okay. This is a lower high. Now, when price takes out this, you don't have to fret that the market has changed. No, we need market to trade above this. And as you can see, we have a fake out here. I've explained what the fake out is in my previous video. When you have a close above and the market trade back immediately with a close, I consider that a fake out. So the bearish trend is still in play. All right. So this low created a high here. So these are lower low here. Market came back down. You can see now, you can even start here to form a new internal structure low. Once this level is taken, you can see strong candle, you can move to the downside. Now this is what people do when they see this is a high, now low, taking out this here. This is a higher high, this is a higher low. Okay, I'm reading it in form of the internal structure. Okay, the internal structure. A high, higher high, high, lower low, lower high, lower low. Now the moment someone see a break here, I'm trying to show you where you make your mistake. A break here, you start looking for bullish trade in here, which is wrong. You don't look for a bullish trade in here because this alone did not confirm a break in market structure. Okay, we want to see another high to be taken. Okay, now if you don't understand, let's continue. Then eventually we took out this low. This is the main low here. This is the high. This is the low. Lower high, lower low, lower low here. Okay. A new low is created. A high, a low. Now, most people will see this as chalk, and they want to buy from here. And they want to buy from here. What happened? Price gave a reaction and then eventually move. Because you don't understand what constitutes a true break in market structure. Now, let's continue marking the structure. This is the high. Yeah. We broke this, creating a low here. This is the high, creating a low. People will look for this. Oh, we have a chalk. They look for trades. In this case, they got excited, move up, the price came back and take it out. Okay, creating a new low. This is the high that took out that low. So this is your high now. All this high that you mentioned before, because the market was like this, you need to label your chart. Okay, you need to label your chart. Yeah. Forget what has happened on the left. You need to label your chart. But the moment price trade and created a new high that eventually break the low, you can now leave this as your lower high, and this becomes your lower high here. Okay, because it was the high that started the move to break this low, not this. Okay, this was now a form of what liquidity, but you can look for trades in here. If you combine what I'm showing you with the opening price strategy, you put the odds in your favor and push your trade to the top 5% traders. Okay, so now in this case, look for a sell in here to push price. Now what push price down here is this hidden base here, supply zone sell. I'll look for more sell in here to continue going, treating all of this as what liquidity there. All these serves as liquidity for this to hold to break this low. We have a high, low, another lower high because it didn't break this high. We didn't have a close above. We only have market sweeping that high, creating a new low. So in the real chart, it becomes a bit tougher, but do not worry. Use what I'm teaching you here to break things down. A low, a high. Now this high fails to break a low, makes it what is a weak high. Remember what I talked about weak high? A weak high is simply a high that did not take break structure and it didn't take any form of liquidity swing. Okay, if you have not seen that video, I'll put a link in the video in the description or up a card up here for you to go watch swing high, strong high handles, weak high handles. Okay, so all of this produce weak high and low, which can now give you an easy understanding of what liquidity. Then what happens? Price trade up, you take them as liquidity. Yeah, whatever point of interest is in here, you take your trade and then target this low. So that creates a new low. This is not a break, this is a break. Push high, another break here. So we have this break now. Most people will take this as chalk. They take this as chalk and they want to be trading from this order block. This is a trap. Market gave you a reaction. If you are smart and you are scalping, you will know how to get out of this market, because the moment price tap into this hidden base, this is the target, and there they form what equal lows here. This leads to what equal lows, and these are strong liquidity points where you can aim when you are entering here to target this low. Now this high created a low here. This low push up, creating a high, but this high did not break this low, so it's a weak high. It needs to be taken. This high did not break the low. It needs to be taken. The moment they take it, probably into a point of interest there, in this case a fair value gap. Okay, fair value gap. Price created a new high, and then that high took out this low with a break. Okay, even though price came back in, this looked like a fake out. If you sell, try to sell, and then we have the eventual break of market structure here. Price trade back up. Now in this case, some people will call this a chalk because it took out this high and they want to be selling or buying in here. What happened? Price took them out. This is a trap. This is what you have been doing and you are losing. Do not do that. Price took that out because they don't understand the market structure. Now this is not the high that broke this. This is the high. So this leg here is your first point of call. What high created this low that was broken? This. So mark those two out. It is when market takes out this high that we have a shift in market structure, not this. Okay, because this just is a recent break here. Now market move up, failure to break, weak high. Weak high is a liquidity, you target it. This also fails to break, weak high, move higher. We have a break above this. You can look for a trade in here. Okay, now remember, because you are following your rules, you take a loss here. Then you monitor. You can see that we have a break above this, signaling that the market has shifted. Now once you take this loss, remember you have been profiting from this trend here. Once you take this loss, you simply shift. That demand that took out that high are where you start looking for what trades. go for trade there, go for trades here, go for trade in here as well. And you can see we have a new trend moving. So that means our new structure low, a high, lower, higher high, higher lows, higher high, and so on. You continue like that until the market is where it is now. Okay, so this is what I want to share with you. If you enjoy it, like this video, subscribe to the channel, share this video so that more traders can learn from their mistakes. On that note, I will see you in this video.